Vetri Subramaniam is with us, Chief Investment Officer at UTI AMC. Vetri, great to have you with us here. Good morning. Thanks for your time. How are we looking in the near term? And then, beyond that, do you think we are at the cusp of a bit of a sell-off in what has been a pretty good bull market and perhaps remains so?
Morning, Prashant. Good to be here. I don't have much of a view on that, Prashant. Don't really trade the market looking at such short-term moves. We're sort of focused more on the longer-term moves in the market and construct portfolios based on that. We tell our investors to think long-term, and that's exactly how we tend to behave ourselves. So we don't try and chase the market in terms of short-term moves over weeks or days.
That's perfectly fine. But do you have a view, Vetri? In terms of broadly, is it a time to dip in aggressively? Is it time to pare back? Just a broad kind of view.
Sure. No. Yeah, let me sort of fill you in on that. So, internally we do run some asset allocation models which feed into our advantage and multi-asset strategies. And this is really a composite of valuations that we are looking at to determine how attractive equities look at every point of time. And that sort of stuck, I would say, somewhere between neutral to expensive. So to put it in perspective, Prashant, if we find equities really unattractive, the model can drop allocation all the way down to 30%. And if we find valuations usually attractive, it can raise the allocation all the way up to 90%. It's pretty much stuck right in the middle right now at about 60%. And, when I look at particularly the mid and small cap segments of the market, there's some element of them actually being slightly richer than even the Nifty, which is the primary model that we look at. So I would say, this is a time to sort of manage your risk, stagger your investments. And if you're choosing to make large investments in the market, then, you're sort of in that neutral zone as far as valuations are concerned.
Vetri, morning. What's the best way to manage your risks? You said that the valuations in small caps is slightly on the higher side. Would you reduce your allocation to small caps? Which would be the themes that you would bet on where you're still comfortable with the risk reward?
Sure. I think from a market cap point of view, Reema, we'd be most comfortable with the large caps, followed by the mid caps, and least comfortable with the small caps. Having said that, I should say that this was my view even 3 months ago, and I'm surprised by the strength that we've seen in small caps during this period. But to my mind, not just the valuations, but also looking at the macro environment where, rates look like they're going to be higher for longer in India. Certainly that's the case globally. Global growth, certainly the US proving to be quite resilient, but it's not like global growth is gangbusters, so we haven't really got positive sort of tailwinds kicking in from there. It's not a great macroeconomic environment from my point of view for the mid and small cap parts of the market. So large caps is where we have the maximum comfort. I think from our point of view, one of the more contrarian calls we had was more sector rather than market cap, which is the pharmaceutical space. Again, that's been something that I liked even in 22. It didn't do much, but in this year, finally, it's sort of starting to show some good performance, and that would continue to be an area or a sector that we would back with sort of valuations in favor, and I think, still sort of contrarian positioning over there.
Hi, Vetri. Good morning. Well, as we speak, the Nifty is at its lowest levels we have seen since, I think, the 4th of July. So, a bit of selling is what we are seeing creeping in there. Well, Vetri, you get the point. US economy is actually looking solid, more solid than what most were expecting, and you're sounding a little bit cautious on the broader markets. But in a couple of aspects, Timken India, they have put it on the exchanges that demand is a little bit slower. And after a while, we are hearing things like this. Do you think the Indian economy as well in the near term could be in for some softness? Premiumization, yes, that's picking up, but there are pockets which are still in pain. Your view on it?
No, certainly, Nigel. I think, I'm sure, and I don't want to go back to the K-shaped recovery. That's certainly been something which is visible when we look at the data of companies. There's a big divergence in terms of the kind of income class to which companies are selling their products. Those selling to upper and higher income categories have actually done far better than those selling to the lower end. I think as far as growth is concerned, I would just say that, look, we've come out of this pandemic period in really good shape relative to other parts of the world, but it puts us on track trajectory for maybe 6% GDP growth, give and take a little bit here based on how global tailwinds and headwinds sort of pan out. It's not like growth is like off to the races. And I think when you look at the commentary that's coming out of the MPC, which is essentially saying that, we are concerned about inflation. We don't really see any rate cuts on the horizon. We are going to continue to persist with, withdrawal of accommodation. You get a sense that, we are in a reasonably good place, but not like we are off to the races. So that, to my mind, is a little bit of a challenge when you talk about, having very elevated growth expectations. And I think the other factor, which perhaps in global markets we will need to sort of pay some attention to, is while the US has certainly surprised in terms of the strength of the economy, China is proving to be a particularly significant pain point at this point, not just in terms of growth, but also in terms of the fact that it's now starting to export deflation. Not a bad thing given that everybody is concerned about inflation, but it has longer term ramifications.
Yeah, no, absolutely. I put out a piece on Friday on China, and with a slightly longer term, it's kind of headed Japan's way from 30 years ago, when we had a very prolonged kind of downturn. But that's, one for the long term. Vetri, so you said large cap orientation, right? So what happens is one gets to get carried away and kind of, because the most money has been made in small caps. So I'm assuming that, and we've not had this downturn for a while. It's just 140 points right now, but we've not even had that. The small cap index is down 1.5%. And I think you can count the number of days the small cap index has been down more than 1% since the rally started from late March. So if for those who are heavily into this part of the market and are watching this, the natural impulse which kicks in, well, it'll be okay. So you think they should actively kind of look at moving investments into large caps, that kind of thing? Your advice?
Sure. Again, I can't give a one-size-fits-all prescription to everybody out there. But from a valuation standpoint, I do think, the small caps give me the least comfort. I also think, Prashant, we've got to be a little bit careful, when we look at year-to-date data, or even if you look at 3-year data, you're picking up a very favorable base point in terms of the returns from small caps. If I just shift the horizon to, let's say, 5 years or 7 years, things will suddenly start to look very different. In our sort of modeling, when we look at the data on a rolling basis over much longer time periods, actually the most attractive segment of the market over the mid to longer term tends to be the mid caps, which not only gives you better returns than large caps, but is also superior on a risk adjusted basis. Actually, this is not true of small caps. Now, there could be some individual small cap funds which do well, but when you look at the small cap index, its risk adjusted returns are actually not very great. So to my mind, that will continue to be a little bit of a cautionary note as far as small caps are concerned. And historical experience, been in the market for 30 years now, every time you see the economy go through a little bit of pain, the companies which are most vulnerable to that tend to be the mid caps, tend to be the small caps. So that's where I would sort of raise that flag of caution. I don't know individual people's allocations number, but certainly given the valuations, I would take some money off small caps and move it to large caps.
Always good hearing your thoughts, Vetri. Thanks so much for stopping by and filling us in with your commentary. So not a bad idea, I think, to be a little bit cautious and maybe finding more comfort in large caps in comparison to the smaller cap names.